Hey, good afternoon, everyone, and thank you for attending this webinar. And what I'm going to do is go over with you one of our new systems. And I should introduce myself. Probably I'm Mark from Right Line Trading, and just this is our disclaimer. That trading the future in the forex markets involves substantial risk, and it should be understood that a person can lose substantial amounts of money. Therefore, the participation in these markets is not appropriate for everyone. Careful consideration of your financial position should be made prior to trading. Never risk more than 2% of your account at any trade. Do your own due diligence. And we here at Right Line Trading are not registered financial advisors, and we're not licensed commodity trading advisors. So with that said, and something I think everybody understands, just a little bit about myself. I'm a graduate of the University of Pennsylvania. I'm a former professor at Jefferson University in Philadelphia. I've been involved in the financial markets for it's really close to 20 years, over 15. And I began trading the futures and forex markets about 10 years ago. And I've been involved in the optimization of software systems for the last 10 years via mathematical modeling, and that really has led to the creation of Right Line Trading, which is at www.rightlinetrading.com. Now, I know that a lot of you are in the room because you're looking for a sound trading methodology that's going to provide you with a nice return on a low amount of risk. And that's a very, very difficult, that's a tall order in the futures market, because the futures are such a highly leveraged financial instrument. Developing an excellent risk to reward entry that gives you a probability of winning 80 to 85% of the time, or even greater, is difficult. And a lot of you have bought expensive software and you've still lost money. You may have hired an expensive mentor and continue to lose money. And I just want you to know and try to assure you that you really are in the right place. So what I'm going to show you now has a remarkable track record, which I'm going to go over with you. And I'm going to show you the equity curve. And in this webinar, I'm going to show you the nuts and bolts. And we've added a component to it, which makes it even more powerful. And if there are people in this webinar who own the core system, either the transition zone discretionary or algorithmic, this is a component that may benefit you, and I think it's going to help everybody. Now, as I said, the transition zone trade is one trade configuration, and it's the most profitable trade configuration that we have. Greater than 85% of the entries are winners, and it's superlative risk to reward. You risk about $1 to make a potential $3. And I'm going to show you how it leverages the direction of institutional money flow. And with as few as 2 contracts, you can easily make as much as 500. Now, the important thing to remember in trading, and this is a big mistake that almost all commercial traders like ourselves make. We're the small guys. Is that we use indicators to help us trade that are not independent variables. They don't independently predict how price is going to move into the future. What they are dependent variables. And what that means is they just follow the movement of price. When price goes up, the indicators go up. When price goes down, the indicators go down. If it's a MACD and price falls, MACD crosses to the downside. If it's a stochastic and the market goes up, the percent K line is going to go up. It tracks price. What we wanted to do are create indicators that do not require or purposely do not use any of the data from your trading chart. They use the data from the 2 higher time frames to create their directional bias or their trading entries. Therefore, they create an independent predictor of price. Now, this is called our right line bias. And this bias is created when your higher two time frames are aligned to the downside and all support to the downside is broken, which means you have the market in free fall. So the price on your trading chart, this is your trading chart. This is an 5-range crude that I took out in August of 2015. Price on crude doesn't fall and turn background pink. The background bias turns pink because your two higher time frames have now met the standards for being in a downtrend, and all support on your two higher time frames is broken, and your two higher time frames are now moving nicely to the downside. The shorter term time frame, which is your trading time frame, is almost always going to fall. So this pink heralds or is a harbinger of price fall on your trading chart. All you're looking for on your trading chart is a nice entry to the short side. You're only going to trade short. You know that a short trade is going to give you a high probability winner. You just got to get a nice entry. And you would never trade against the direction of background bias. Now, in order to get a multi-time frame alignment, and in this particular case, it's 3 time frames. It's your trading chart and your 2 higher time frames. You've got to have the participation of institutional money. Only institutional money can create a downdraft on 3 individual time frames. And I think it's important to remember one thing, and I'm not flipping through a lot of JPEGs, but I want you to remember this, that the market is like a closed system. And if you apply it to the laws of physics, which is very, very important because it gives you a better fundamental understanding of how markets move. And remember that every closed system in physics tends to move in increasing randomness unless there's the application of energy to a closed system in physics. In our closed system, which is the market tends to move and chop unless there's the application of something, and in this particular case, it's the application of big money. So without big money coming into the market, you're going to get 3 time frames, all of which are non-aligned, and which your trading chart time frame is in chop. And just to make one more point on this, if your trading chart appears to move with the trend, but the trend is not aligned with your 2 higher time frames, that can just be a random chance event. It may not be because you have the application of institutional money. What you want to see is institutional money swing around the market and have 3 time frames aligned to the downside. Then you have a clearly defined trend. And this is where you're going to pick up the highest percentage of winners. It's not necessarily going to be when just your trading chart shows a trend. It's going to happen when you have a multi-time frame alignment of trend. That's what background bias demonstrates. Now here's the other indicator that we leverage very heavily upon, or use very heavily, and is also a clear independent predictor of market direction. Now remember, we don't use anything that assimilates data from your trading chart. And what these are is these are quant lines. And what quant lines do is check the direction of correlative markets. And correlative markets, if you know how the financial markets move, and I'm sure that probably a lot of you already do, you realize that in the course of a day, there's pretty much a fixed amount of money in all of the financial markets. And that includes all the index equities like the NASDAQ, the Dow, the Russell, the E-mini S&P, the bonds, notes, precious metals, agriculturals, currencies. In all those markets, there's a fixed amount of money. Obviously, there's some money flow in, there's some money flow out, but for all intents and purposes, there's a fixed amount of money. And what the institutions do throughout the course of the day is they rotate their money through different asset classes depending on their perception of risk. Now, some of these asset classes are either directly correlated or inversely correlated. So, for instance, to give you an example, there are 3 markets in each of these lines. So we're looking at 6 correlative markets, and they must correlate with a correlation coefficient of 0.7 or greater. And what that means is when bonds go up, they have to go up 70% of the time or greater with bonds, or fall 70% of the time with bonds. And we did a lot of work to determine what 6 markets either have a direct correlation or an indirect correlation coefficient of 0.7 and will either move up with bonds or move down with bonds. Now, the markets that move up with bonds have institutional money flowing into them. And the markets that move down with bonds have institutional money flowing out of them. Now, when both quant lines are green, now the reason they're called quant lines is that the markets are quantitatively weighted within the lines. So, what the markets that we have in here are proprietary, but I can give you one of them. The market that correlates very highly with bonds are Treasury notes. That has a correlation coefficient of about 85%. So we quantitatively weight that more heavily in the upper line. So the 6 markets that are here are given different quantitative weights. But when all of them are moving in the appropriate direction, indicating that money is flowing into bonds and it's directly correlative markets, and it's moving out of bonds in the markets that indirectly correlate, we know that the institutions are doing an asset class rotation, and that money is coming out of that whole basket of markets and moving into the basket of markets that move up with bonds. So price doesn't turn these lines green. It doesn't even look at the price of bonds. I mean, bonds could be heading straight down, and these lines would turn green, because these lines are looking at money flow at the correlative markets of bonds. So it's very, very likely that when all 6 markets correlate to show you that money is flowing into bonds and its correlative markets, bonds is going to move up. Here, bonds is going to move up. And all you're doing is, first of all, you're not, when you have 2 greens or even 1 green, the dual greens give you an absolute bias to the upside. All you're going to do is look for a trading entry and a move to the upside. There's no way you would trade against this direction. And this is one of the reasons why counter-trend traders fail. What they're doing is they're trading against the direction of an indicator such as this or the last indicator. There's a multi-time frame alignment to the downside, and they're going long. They're trading against the flow of institutional money, which is required to create a multi-time frame alignment, either up to the upside or downside. Or they're trading against the money, the big institutional money, which was creating this really significant class action or sector rotation of money into bonds. So these are both independent predictors of price movement, and they're very powerful independent predictors. Now, both of these indicators are leveraged when we trade the transition zone. Now, the other thing that we must look at is, remember, all of the other 2 indicators we just looked at set a bias. They tell you the direction to trade, but they don't necessarily give you an entry. But remember that your trading chart must also align. And in essence, what I tell the traders in our trading room is, we look for our trading chart to be heading to the downside, and then, and only then, do we look at background bias and wait for it to go pink, and we look for the correlative markets to go red, our quant analysis indicator, and then we look for a trading entry on our trading chart. Now, an additional configuration that the transition zone trade, or the transition zone system looks at, is market structure on our trading chart. But it leverages both of those indicators to take a trade. And here's an example. Here's where we're looking. We know we have the 50 down and the 15s down. Now, I don't have it here, but background bias is pink, and the correlative markets are also red. Now the market moves into consolidation. And consolidation is the most powerful signal that there is in the market. Because what happens in consolidation is that you trap traders in the trend, in the direction of the trend, which is all the traders short. But it captures, and these are the commercial traders like us. Institutional traders do not create these two counter trend candles. And this is why so many small commercial traders like us fail. This is what they're taught to do. They're taught to trade MACD divergence, or to trade oscillator divergence, or some other signal that places them in the counter trend position. And what we do is we leverage those traders and help us get a successful trade. Now, they're caught in the counter trend direction, and consolidation almost always breaks out in the direction of the trend. The only time it doesn't was when the market is oversold or overbought. And this market is definitely not oversold. So you're anticipating a break to the downside, and the market moves down with two forces. One, it's the addition of new sellers, because this is an institutionally created move. It's a multi-time frame alignment, and the quants. So you have the institutions still actively participating in the trade. They're going to throw in more short contracts, and the market's going to push. The additional force is that when these counter trend traders get stopped out, they've bought the shares, they have to sell them in order to close their position. So for all the counter trend contracts purchased long, they got to buy them, they got to sell them, and they help propel the move to the downside. So this is this trade occurs very forcefully to the downside. Now, I wanted to give you a little bit of an understanding, and this is an actual transition zone trade. It's 17.5 points. Now, what we do is, this is the transition zone algorithmic signal. And what the transition zone is that first candle that aligns the market to the downside on 3 time frames, your trading chart and your 2 higher time frames, with all the quant lines. There are 9 on the E-mini. So there are 9 quantitative markets, or correlative markets, quantitatively configured in this indicator, and they're all telling you that money is flowing out of the E-mini. And so what you look for now, if you're on the algorithmic system that triggers automatically, it's going to take the first pullback into the downtrend and take the continuation trade down, because that's an extremely conservative trade. Because on your trading chart, it's a counter trend move against your 2 higher time frames, right into upside resistance. You get an algorithmic entry automatically, which carries the trade down 17.5 points. But you need to have everything aligned. Now, the algorithmic system makes an assessment of trend force by looking at the slope of the 50, the slope of the 15, and algorithmically determines how many candles it's going to give you into the transition zone before it will stop taking a retracement. It usually has to come within 5 or 6 candles. The algorithmic system also determines how far off resistance to the downside or off support to the upside the open of the candle has to be before it'll take a trade. And it's got to be pretty tight to resistance on a short, pretty tight to support on a long. The system, this tells you the system's on. It enters you automatically on a close of the candle, 1 tick below, and on a very liberal ATM would take you down 17 points. Now here's another trade, and this is a live trade. You can see the pullback occurs with the creation of the zone. These are extremely powerful. Now, the algorithmic line is not on here. And what we did is this was back when we didn't yet project it. The algorithmic system turned on, but traders in the room wanted to actually see that algorithmic switch on. So what we were able to do was to enable that black line. It comes right here, and there's a 15-tick stop, and this has been scaled. This is a 14-tick pullback. This goes all the way up 61 points. Now you're on a 15-tick pullback, and there's no reason to. Oh, the trade is going to exit. Well, the pivot's not here. Excuse me. So you're going to take a 15-tick pullback on a 61-tick move. So on 2 contracts, you make 7 at the first target, and then 15, let's see, I think that's 46. That's 46 ticks and 7 ticks. That's a $530 trade. Letting this come back all the way 15, and that's what you would do. Because there was still room to move to the upside. You don't know where the trade is going to close. Well, here's another one. There's the algorithmic system firing, and you see you get an early retracement. The algorithmic system fired, and you're down for 34 ticks on the crude. On 2 contracts, you make $360. Here's another trade. There's the line was just configured thinner. Actually, it's over here, and this is not a transition zone signal, but the algorithmic system switches on right here. You get your early retracement right here, and you're down for 33 ticks. Here's your perfect trade. It's when you get the retracement on the transition zone signal. It's a trade out of consolidation. There's the triangles consolidation. This is on crude down for 27 ticks. You'll notice that in order to take the trade, you've got to have the 50 red, the 15 red, and you have to have the quant line red, and you have to have background bias pink for a short trade. Those are algorithmic mandates on the trade. Here's a move to the upside. This is a beautiful move on crude. You have the move up, breaks the pivot, comes right back to support. Algorithmic system enters, and the trade goes up 39 ticks. Now remember, you can take these trades out. If you're on the algorithmic system and you think 35 ticks and 7 ticks is enough, that's $420. You can close the trade anytime. But if you let it run, you'd make 7 on your initial contract and 39 minus 15, which is 25. So you make 25 and 7, which is 32 contracts, 32 ticks, I believe. I hope I'm adding right. But you make a really nice amount of money on only 2 contracts. And the risk here is a close on a down close candle. You take an initial 10-tick stop, but every time the trade pushes up, it moves where the reversal candle is going to take you out. I'm going to show you that live on the platform. So as the trade pushes in your direction, if it pushes up 4 or 5 ticks on your 2 contracts, the $200 risk that you initially enter the trade on slowly starts to get smaller and smaller and smaller. And if you miss that 7-tick first target, your exit is only -1 tick. You only lose $20 on the trade. That's why the risk is so low and the reward is so high. And if you don't get a first target, almost every trade pushes up close to it. So it's a very, very conservative strategy when you reverse and are taken out on a reversal candle, and the algorithmic system is set up to do that for you. Or you can do it on a discretionary basis. I call all these trades in the room, in our trading room. As soon as the algorithmic system triggers, I hear it, and I let everyone know there's a trade. So you can take it on a discretionary basis. Now, what we added here is our dashboard, and this is an optional add-on. And I'm going to show you the dashboard live. And I don't have any video of the dashboard in action, but I think you're going to see it on our platform working. And what the dashboard has is all of the major independent variables that you need to get a transition zone trade. And you're going to see here when everything aligns, the alert is going to give you a visual and audible beep that tells you that gold, the E-mini, the NASDAQ, crude are now all aligned to the upside or the downside. Then you just bring the chart up, and the alert fires when bias, which is the background bias, turns pink or green. So it tells you, okay, I've got a potential trade. Now all I have to do is wait for the first retracement, and if one occurs, I can take it on a discretionary basis. It allows you to monitor. You can monitor 12 futures markets, 15 futures markets if you want, in order to get more trading entries. Now, I'm not going to really go over the entry criteria because I think, it's the fixed entry criteria. I mean, I can do it really quickly. The entry criteria is simply an early retracement after the transition zone on a background that's pink or green. You enter on the first retracement only. The second retracement weakens the power of the entry, so we never take a second retracement. After the entry and after you enter, first target is 7 ticks, stop is -10. Now remember, the 7 ticks we determined after 2 years of market replay data showed us that that's the optimal place to take out your first contract. Now when that first contract is taken out, nothing happens to your stop. You're still at -10. We want to give this trade an enormous room to breathe. So you're at risk for $30 on the trade. Then when the target hits 10, your stop goes to -5, and now you've locked in $30. So if it goes 10, you make a McDonald's hamburger meal. You make a McDonald's dinner off the trade. And then if it keeps running, the upside potential is unlimited. So it trails the trade by 15 ticks all the way. Now, there's certain exit criteria that the algorithmic system takes. Obviously, if it comes back 15 ticks, you're out. But there are also other exit criteria, which are actually, here are the exit criteria. The 15-tick trailing stop is hit. If you hit any upside resistance on a long trade, you're out. The system never takes the position that you're going to break upside resistance. If you hit downside support, you're out. Right at the area of support or resistance. So if you bounce and get taken out, you save the 15 ticks. And then we have an indicator, which is our 15-day or 15-period proprietary moving average. If that turns yellow, the system closes the trade. It tells the system that the trend on our trading chart is over. And that creates the most conservative exit we can get. If you don't hit upside or downside support resistance, if you don't hit if the modified 15 doesn't turn yellow, yeah, you're going to have to take that 15-tick trailing stop on the exit. But it's only this huge breathing room. And the 15 ticks we also determined. We have lots of trades on crude that come back 13 and 14, but for some reason don't go 15. And we did that with 2 years of market replay data. Now let me just escape and let me just go over to the actual charts. Now these are our charts. And let me show you. Now here is a potential transition zone. Right here. Now the reason it didn't trigger was because you've got upside market profile. That's the value area high. It will not take a trade into upside resistance. In this particular case, it blew right through it. But the system is not going to anticipate that. Here's your trade. Right here. Well, sorry, we had this yesterday. And the trade was censored by, again, by the value area high. Now, if you want to take the high, the really high probability winners and eliminate risk, you cannot trade into upside resistance. And unfortunately, these are two trades that just blew right through. Nope, it's not one. Now, normally, when we look for one, we find one really fast. And here is a trade. Now, I don't know if the algorithmic system would have taken it because it's pretty far off support. 7 ticks. But you can see it never stops out. And here's what you would get on this trade. You would only get 7 ticks on 2 contracts, so it's going to take it off at upside resistance. I wish I could find the big runners, but I will. The key to the trade is you just don't want to lose money on any trade. And here's a smaller trade right here. This is a retracement candle with a consolidation entry on a transition zone. And you can see this is 16 ticks. Again, not a big trade, but a winner. And you see it meets our criteria. I think the quant line is red, background bias is pink. It's an entry out of consolidation. This is order flow and momentum. And this is called our volume hammer. It's a very, very unique indicator. And I don't really want to go into it because it's another complicated discussion. But I only want to show you the trades that the algorithmic system is really going to take. And then I'll show you the track record. And then I want to show you the dashboard. Now, lately, the market has been very, very, very choppy. And here's a 37-tick trade we took in the room, but it was not an algorithmic entry. It was a 21-tick trade. And this one was a loser that I took. And I'm definitely not going to tell you that I take all winners. I'll tell you that. Here's the trade. I have to take all this stuff off because I was mapping this out for everybody. Here's your first retracement. And that goes 32 ticks. Here's a transition zone that went 13 ticks. The trade was closed right at upside resistance. The trade made $140 in real-time live on 2 contracts. Very, very small number of contracts here. Let me just bring up the dashboard. I don't know where it went. Oh, I know. Okay, hold on. I know why it's not there. I have to connect the workspace. Hold on a second. Let me disconnect and reconnect. That's connecting. Okay, here we go. Now, hopefully, the dashboard's going to come up. Because when I close the system, oh, there it is. Okay, here's one of them floating around. Hold on one second. They'll come up. Now, the dashboard can be used independently of the transition zone system as well. I use it to trade Forex, and I use it to trade stocks. And you can use it to trade futures if you want to monitor 5, 6, 7 futures markets. It's going to tell you when you've got all the independent variables aligned for you. Now, here's the ES dashboard coming up. Let's move it up here. We'll just wait for the crude dashboard to come up. And I'm just going to show you something that's very, very important to note. Okay, and here comes the crude dashboard. Now, if you look at this period here, just waiting, I have so many charts on my workspace that are loading. Just give it 1 second here. And I have a little bit of extra time. Then I'm going to take questions. But I just want to show you a couple of things about trading and why the transition zone is such a good trade. Now, what you can see here is, here's background bias. Here's the color of the first quant, the second quant, the third quant. We want the modified 15, which is our proprietary 15, to be green. When you get green, 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 the alert goes green and you get a beep. Now, let's say you want to trade the NASDAQ and you want to trade gold and you want to trade bonds, you want to trade notes, you want to trade the Dow. When I was trading the Forex, I traded 12 Forex pairs. What I did was I just aligned the dashboards all the way down the side. And I didn't even look at a market until I got an alert. And when I got an alert, I'd have the chart like this, small. I would just pop it open. Now, and this is what is important, and what I would like you to see. When you have no background bias and no quant lines aligned, you can see how clearly the market moves in chop. And I think the primary responsibility of your platform is to clearly define chop for you. If it doesn't, you don't know when to take a trade and when not to take a trade. But you can see clearly here, not just based on price action, But what your anticipation is that when you've got no background bias or multi-time frame alignment of trend, and the correlative markets are all moving in the opposite directions, you're just going to stand aside. And it happens again. Let's look for a long space here, because today's market was just all up. Look right here. During this period of time, now we don't trade on a yellow modified 15. When the modified 15 is yellow and background bias, there is none, no multi-time frame alignment. I mean, we've got our first quant's our major quant line. I mean, there's no alignment here. So you clearly see that you have no trend, and there's no institutional participation of money. Then on this A candle right here, you get the first line green, the third line. This is our major quant. The bottom line's our intermediate quant. Now you have an entry. The problem with the algorithmic automated transition zone is it's trading into a pivot, and it won't trade into an upside pivot. But if I could pull this back, this dashboard would be green across the board, the alert would fire, then you have to bring up your chart if you're trading on a discretionary basis and check to see if you have any upside resistance. If you don't, you've got yourself an entry right here. Now, if you think that that upside resistance will break, you can take the trade. We rarely anticipate that. So this trade got away from us, but we had a trade entry here. And we had with our minor quant and our intermediate quant, and we had a momentum aligned multi-time frame to the upside, order flow aligned multi-time frame to the upside. And up we went for a huge move. But that was a discretionary trade. But what I just want you to do is see that when you have the green background bias and the quants, how and no upside resistance on a long or no downside support on a short, how conservative the trade entry is. And the only other thing that I want to point out, and I'm going to show you a video of a trade, and we have, this is called our volume hammer. And let me just tell you really quickly what the volume hammer is, just to help you with your trading. Let me just go to the indicators here. Because I take the words out because they bother me, and they kind of, sometimes price is right. So what the volume hammer is, it's a second order equation. All the indicators that you have create, now here's a potential transition zone right here. You see the algorithmic just went on? Now we have the zone off, and we're not going to, this would not fire a signal out to anybody. But there, the algorithmic system just went on crude. Now, if we get a B candle pullback and a continuation long, and we had the system on and was sending out signals, everyone would get a long entry here. Now, it's got to do some work because there's hardly any volume. But if this was crude at 9:30 in the morning and we got a pullback, you can see there's no overhead resistance to the trade to the long side. And the B's coming, the algorithmic system is watching, and it's going to take a signal, but we don't have it on right now. It's not going to send it out. And what I just wanted to say really quickly about the volume hammer is that everybody shows you price per candle, volume per candle, and that is absolutely useless. It doesn't matter if you're trading Renko bars, time, tick. Sometimes a lot of contracts cross, but the power of the bulls and the power of the bears equal each other. So you just don't get a lot of candles forming. I mean, I've seen on the E-mini yesterday, we sat in one candle for 25 minutes on decent volume. So if you were just looking at contracts per candle, the candle accumulates a huge amount of volume, but it's a meaningless volume spike. because it took 25 minutes for the candle to create an up close or a down close. What we do here is calculate contracts per minute, and this is the rate of change in contracts per minute. So what we want to see on an up move, now remember, you cannot go back and look at what's under the candles, because this is moving as on minutes, and this is moving on candles. The only accurate assessment is right here on the right edge. Everything else is moving faster than the candles are. But what we want to see is this. On a move to the upside, we want to see the rate of change in contracts move up. We want to see volume, institutional participation increase. And like here. And that's very, very helpful. And this is the same for a down move or an up move. We want to see the rate of change in volume go up faster. Now let me play you the video of a transition zone trade. And I get a little excited during the video, so just don't mind me. But I want you to see how the trade system works. Now here's the video, so hang on 1 second. Now I'm quiet here, but it's already triggered, and we're just waiting. You see all three quants are red. We have the top line here is multi-time frame momentum. Bottom line is multi-time frame order flow. Orange is fine on the entry. There's the algorithmic system looking for the pullback. We get a C pullback early, and this is on the E-mini. And the E-mini is not an easy instrument to trade. And you can see in the lower right-hand corner what's cranking through. These are the number of contracts per minute. And we know on the E-mini, we want to see between 1,500 and 2,000 contracts at a minimum to feel very comfortable with the trade. You can see it's at 2,000. I mean, I get excited and yell. I don't usually do that in the room, but I do on the transition zones because I really. I'm going a little crazy, but I want you to see the power of these trades. When you have the quants, you have background bias, you have order flow, you have momentum, they're all multi-time frame aligned to the downside. That's the way money is being pulled out of the market. It's being pulled out to the downside. Because I don't want you to see this as a black box entry. Now, on the discretionary system, I'm going to have to teach you how to take these entries, and we're going to have a webinar if you purchase the discretionary. And I'm going to show you exactly how to take the trades. Now look at the number of contracts crossing per minute. It's at 5,000. It's at 6,000. I mean, I felt very comfortable on this trade because it was moving down with tremendous volume. And resets back to 0 every minute. And you can see where the trailing stop is. We're only trading 2 contracts. I mean, we could trade 6, we could trade 8. We have people in the room trading 20, between a 20 and a 50 lot. Now we're trading 8,000 contracts a minute, 9,000 a minute, 10. See, we're out. And you see, look at the volume. I'm gonna, I'm gonna turn it off because I find myself annoying. But you could see on the trade that trade was into 15,000 contracts a minute. So as it progressed, you really anticipated really nice follow through on the trade. Because as it moved down, the rate of change of contracts per minute increased into the trade. And we didn't yet have this indicator. We just had the histogram. And when you see volume increasing into the trade like that, you can anticipate a nice move to the downside and a continuation of the trade to the downside. So let me just go over our cost here, and then I'll answer any questions that you have. Now, normally this is the discretionary trading platform. I call the trades in the room, but I can only call them on two markets, the ones I look at, which are E-mini and crude. If you want the dashboard, you'll get the signals for the potential trades on multiple markets. Now, normally we charge per market. But for the special, it's $7.98 discretionary, all markets, and that's lifetime. If you want the algorithmic system, it's $16.99 automated. It enters the trade for you, and it manages the trade for you on all markets. If you want to add the dashboard, it's $999. And we're giving you an early bird. If you buy it until midnight, we drop the dashboard to $599. Now, everyone who purchases, I always do this. I'll hold a webinar on exactly how the trades work. Even if you're on the algorithmic system, right now the algorithmic is only on the E-mini and it's on crude. Right after the holiday is over, it'll be active on gold and it will be active on the NASDAQ. If you don't buy the special, you have to pay more money for those additional markets. But during the special, we're giving both discretionary and automated prices for both markets. And we're going to be adding more and more to the algorithmic system to get you more and more trades. Now, if you want to use the dashboard, either on the algorithmic for markets we're not at yet, or on the transition zone discretionary, where you have to push the button, you can watch 12, 10, 11. You can watch the 6E in addition. You can watch other currencies. You can watch the agriculturals. You can watch the Dow that we're not on. You can watch additional markets for just that one trade configuration. Now, everybody who gets the system automatically gets a month in the trading room, a month with our NDT. We're just about, our patent is being reviewed right now for the NDT. It took us 2 years for a patent. We had a patent pending. I just checked, and we're now actually being actively reviewed for a patent approval on our NDT, which is the platform that lets us configure those close on and down close, close on and up close, and the reversal candles. Now you get the weekly didactic yesterday was 2.5 hours. I talked about simply trading price action to bring all the traders up from the nuts and bolts. And to everybody, especially those on the automated, they're going to get all new markets as they're added. And we're going to be adding them on in pairs. GC and NQ coming, and I don't know what our next ones will be. I like the 6E. We'll probably go to the 6E, very good volume, and we may go to Treasury notes. Treasury notes, I think, is $15.75 a tick, and it trades 1 million contracts a day. Tremendous volume. It's just a high volume. It has equal to volume on the E-mini, and sometimes it eclipses it. Now our number is 855-765-6681, and I'll just show you, that's our last slide, and I'm going to see if we have any questions. Hang on one second. Okay, we do. There's actually a lot of them. Hang on. Now, I just want you to know that I think we have 16 wins and 4 losers. So we're trading at 75%. That's 4 losers out of 20 trades. We're at 80%. So the and they're all posted to the website. And let me see if actually I could take this off. I do want to show it. And then I will answer everybody's question. Now remember, we trade with very, very small numbers of contracts. So we don't have a tremendous amount of money. And we do that on purpose just because we don't want to blow you away with numbers. A lot of people cannot trade more than 2 contracts. So that's all we bother with. But really, what really is the stellar part of this? Here is, we have 17 wins and we have 5 losers on the transition zone, which is really, really an amazing. Let me see what that comes out to. And that's 21 trades. So that is a 77% win percentage, which is which is, I think, awesome in this trading environment. It has been very, very choppy and difficult. And this is every loser and every winner that we've had live. 77%, just below 80%. Now, I think it'll push higher when the markets start to trend, and they have not been trending lately. But that's the live entries that we take in the room. 17 winners and 5 losers. Now, let me just go over the questions. Okay, hang on a second. I'm going to go to all of them. Okay, Winford, let me ask this. Winford asks, what if you're using a 60-minute chart? How do you know which quant line is the most important? Okay, Winford, here's the answer. The trade works on any time frame, on any type of candle. It works on a range, Renko, tick, or time. It doesn't matter. The longer your time frame, like a 60-minute, the fewer configurable entries you'll get, but the larger will be your potential profit. The system always keeps the risk to reward the same. It's always going to close on a reversal candle, but it modifies the ATM, and this is really important. I didn't bring that up. It creates the ATM based on the average true range of the market, which is market volatility. So it will configure an ATM for you based on the volatility of the market if you're on the algorithmic system. So it doesn't make any difference what time frame you trade, what type of bar you trade. The algorithmic system will do it for you. If you trade it on a discretionary basis and the automated algorithmic system is not operational for you, you have to tell us your time frame and we will configure an ATM for you. We'll run the data for you and give you the best first target, trailing stop, and we're going to have to determine that for you. It's not hard for us because we can run 2 years of market replay data in 2 days at 500 speed. So you can do it on any time frame. Right now, Sam asks, what instruments and markets does this work with? On the automated side, it works with the ES and it works with crude. On the automated side, right after New Year's, we're adding, and I have the chart right over here because we're really looking at it so carefully. I'm adding this market. We're adding the NASDAQ, and we're adding gold. We're adding those two markets. And on the automated system, we're going in twos. The next market I think we're going to add on the automated is notes, is treasury notes. It's a really good market. Look at the volume today on notes. 1,326,000 contracts. And you see it wasn't much of a trending day today on notes. And in order to see it, all I have to do is look at background bias. And you can see that the multi-time frame alignment of notes just didn't happen during the day. So there wouldn't have been a very good trade set up here. But it has huge volume. And so those are the markets. Right now we're on 2. Very shortly we'll be on 4. And probably by the end of January we'll be on 6. On the special, on the algorithm, you're going to get all of them. It's going to be tough to get those if you trade the discretionary system. But if you have the dashboard, all you have to do is wait for the audible visual alert, and then you have to bring the chart up. It's too much for me to do in the live trading room because I got too much responsibility to the members in there, and I got to focus on the markets that everybody has their money in. There may come a point in time where I do put the dashboard off to the side and look for the discretionary entries, but the discretionary system, the dashboard helps me, but right now we're on just 2 markets. The algorithmic, we're going to be on 6 by the end of the month, end of next month. Sam, you can call Rory. Here's his phone number. He's here if you want to call him. 855-765-6681. It's also on our website, our phone number. We're really easy to get. I mean, everybody here lives here. Sorta. He'll be available this evening for about another half hour, 45 minutes. You can have both, Sam. Yes, you can have both. Mark, we had Treasury action today. A Treasury auction today. Okay. Well, that may be one of the reasons why the market was so choppy. No problem, Sam. I appreciate that input. Well, we can just take a really quick look at gold. Now, in order, I just have to refresh because remember, because fractal indicators that use multi-time frames sometimes. Now here was no entry, nothing. See, gold was also pretty choppy today. No entry. Okay, well, listen, that's the system. It's very accurate, and in trading we call that it trades with tremendous precision. You get all the software associated with the transition zone entry, everything you need to make an assessment on the discretionary side. On the automated algorithmic side, it makes the decision for you and manages the whole trade. And if you want, you can get the dashboard as an add-on. If you do the early bird add-on, the dashboard's really pretty cheap. I'll just show that one more time. It's really what we want. The dashboard is only an additional $5.99. And I'll just tell you this: if you ever trade stocks or you ever trade the Forex, and the dashboard can watch multiple stocks. I used to have a stock room, but I was getting too exhausted. I was trading the Forex in the morning, the futures later in the morning, and then stocks in the afternoon. I would trade 12 Forex pairs using the dashboard and 12 to 15 stocks using the dashboard. So if you ever think you want to trade multiple markets, the dashboard's tremendous, because without that alert, there's no reason to even look at the market if you want to take the most conservative entries. You need the multi-time frame alignment with bias, and you need all the correlative markets in your favor. And if you take trades without those, you increase risk. And this is how I'm going to close. I'm just going to tell you this. The most important thing is not getting winners, it's avoiding losers. That's really the mandate of a professional day trader. You will get the winners because there are multiple winning entries. The problem is there are multiple fake outs. When you trade with a tremendous amount of specificity, your mandate is to sidestep the losers. And there's very few trades, although there are, but there are few that don't follow through. When the quants are pulling the market in your direction, the correlative markets, and background bias is aligned on 3 time frames in your direction, and you get a nice pullback, that trade's going to work. So that's it. I really thank everybody for coming in and listening. I mean, even if you don't purchase, I hope you learned something about trading and how important it is to trade into the multi-time frame alignment. And I'll just show you our newest indicator. This newest indicator is this, and it's really a neat indicator. This purple dot, this is one of the most powerful candlestick entries you can get. Now, this isn't an entry, but when this candle engulfs the previous 2 candles, intra-candle, when there's the potential, you get a purple dot below the candle. That's a very bullish. This is not only an engulfer, it engulfs both of the previous 2 candle bodies. That, if you get a good, this is obviously no signal. I mean, this move was just floating in the middle of nowhere. But when you get this dot showing that your entry candle is not only engulfing the previous candle, but the candle before that, it shows you tremendous buying conviction here. And that's a supercharged entry. And that's part of candlestick dogma, but it's very hard to see when you trade 2 instruments, and sometimes even if you trade 1. So we created an indicator for it. Let me just see if it doesn't pop up often, because see, here's just no trade, but this candle to the downside engulfed the previous 2. So we're always looking for ways to leverage it. And the only other thing is anytime we get an upgrade or add-on indicator, you'll always get them. We always throw them in. We never charge you extra or hold back, and we never create a 2.0 version of our platform. So you have to pay for, $1,000 for an upgrade. As we find things, and I'm always looking for things to leverage the markets and get us into safer and safer trades, you always get those. So that's it. I hope that everybody has a really, really nice evening. And really, no matter what you do, I really wish all of you the best of luck. Remember, we're the small commercial guys. We can't beat the institutional guys. What we have to do is make the other commercial traders pay our bills. Let's make them pay our mortgage, our rent, our food, our vacations, our clothes, and put money in our savings account. Because, listen, there's no reason why we can't be better traders than the other commercial traders. These are the guys that take counter-trend trades. We run them over all the time here. I mean, I could give you a million examples. But what we want to do is these are the people, these are the traders taking these crazy trades, trading all kinds of wacky divergent signals. Maybe they're trading fibs. I don't know what they're doing. But they get into multiple moves and they get run over by the institutional money creating the trend, and it helps push the market in our direction. And just remember one thing. The institutions love having people in the counter-trend direction. Nothing brings them more joy than to stop out, than to stop us out. And if they can stop out that move, these traders, when they go home for dinner, they have a bigger smile on their face. And that's what they're always looking to do, and that's why we never give them the opportunity to do this to us. So listen, everyone, have a really great evening. And again, I wish you all the best of luck. Take care, and I hope to see you in the trading room. Bye-bye all.